365. Shake my hand and welcome to 365 Trading Academy. Please don't forget to like, share, subscribe. Check the links down below. Alright, a lot of cool things happening down below there in the description. But until then, roll the intro. After about 8 weeks of doing this course, you'll be asked what kind of a trader you are. You're an institutional trader. And that's what we're going to be doing together, right? But before we do that, just to do some housekeeping rules. Number one, your classes are every Tuesday, Wednesday, and Thursday, right? So this is module 1 classes, and you should by now, right? If you actually went through the correct process of registering or inquiring, you should have a course outline that kind of like details all these dates out. Monday, Tuesday, Wednesday, Thursday, we're doing module 1. Mondays and Fridays are reserved for my module 2s, and then those will be doing the wealthy in 3-year clubs. We'll be talking, a lot over the weekend, etc., etc. So that's kind of like how it works. Okay, now I don't want to waste too much of your time, guys. I will not, and I must start off immediately with this. I will not be teaching you anything to do with indicators. Now, I understand the function of indicators in the markets. If you've never traded before, indicator is basically an MQL, small programs, like a coded program that helps traders make decisions. So you can get an indicator that tells you that price is above average. So we call that a moving average, above average buying or average selling. So if a candlestick, the thing you're going to read on the charts, hits a particular graph line, it's time to buy, it's time to sell. We don't do that stuff in the academy. I understand their functionalities, but unfortunately, because all indicators in general lag, and when they lag, they're lagging off data that also lag. So the stuff that you see on your broker's platform, the stuff that you see on TradeView, whichever broker you're going to be attached to, all that data, those candlesticks, it's not like you're looking at the markets at a rate of 1:1, or it's 6:41 right now. If I go to the markets right now, I will not be looking at the markets at 6:41, right? Because the brokers are printing what was bought and sold via candlesticks, and there's always a lag between those things. So indicators generally give us either delayed information or not good enough. All right, so what we do in the academy, and what I'm going to be doing with you in what we call module 1, right? So I'm just introducing the course tonight because I want you to understand. So from tomorrow when we start, we're all on the same page. Module 1, first of all, sets the scene. My job for the last 3 years in my own corporation, 365 Trading Corporation, where I work with corporates, and the year before that, where I was actually a floor trader, I was simply taught how to follow order flows. And that's what I have to teach you. I have to teach you how to identify money on those charts. I have to teach you how to see that there's now an influx of money on Euro USD at this particular place, and it's now time to buy. Or I'll teach you that there's now a lot of money, but that money is to sell. Because the premises of institutional trading, which is really what we will be doing together for the rest of your life, really. I'm still to meet a student who joined 365 Trading Academy, and then after doing the course, went on to look for another course to do. My heart's desire is to make sure that we're the final stop for traders, right? So I'll teach you everything there is to know about the markets, and then you spend the rest of your life developing yourself as a trader, right? But the heartbeat of institutional trading is simple. You have to trade like the banks, right? So I'm going to teach you how to mirror and track bank movement and private hedge funds. So when I say banks or private hedge funds, we're talking about big institutions, right? What is generally called in the markets smart money. Smart money has a tendency to leave trails, clues, right? that we can use to predict when next price will arrive at a particular area of value. That's what we call them, right? And then what price will do when it gets to that particular area of value. So module 1 will focus on that. I will teach you the 5 types of supply and demand. So not only are you going to become an institutional trader, but the key to institutional trading is something called supply and demand. Now, there are different schools of thoughts around supply and demand. Supply and demand is the hallmark of economics, right? If I have a pen, it's actually a pencil. If I have a pencil, right? And I'm a school teacher, and every student must have a pencil. But I have 20 students, but I only have 10 pencils to sell, right? Because the supply of my pencils is 10, my supply is restricted, my supply is finite. With 20 students all needing a pencil, I can control price. I can manipulate my market for pencils. Instead of charging students $1 for a pencil, since there are 20 of them and they know there's only 10, but all 20 must have a pencil, I can raise this to $10 and start to sell to the highest bidder. I hope that simple example makes sense. Essentially, guys, that is how markets are run. Even though we'll be talking about foreign currency like Euro USD, sometimes we'll look at stocks like Tesla or whatever your favorite stock is, Apple, Google, Facebook, all these things. A lot of the times we'll go to the cryptocurrency market. We'll look at Bitcoin, Ethereum, etc., Ripple, whatever it is. All these assets, to us, it doesn't really matter. All of them are assets. And our fundamental question will always be on the charts: where is the supply? Where is the demand? And I haven't really introduced myself. And so for you who is new to this, academy and new to my teaching style, let me just take a time, to pause right there. The reason why I'm typing on the whiteboard is for this interesting scar on my head. All right. So I'll tell you a little story about that. I have an interesting neuroconnectivity inside my head, something that I was born with. So some of my thoughts race, right? They move a little bit fast, which is not good for teaching. So to slow my thought process down so I can articulate clearly what I want to say to you, it is fundamentally just easier if I just type some of it out on the whiteboard so I don't lose track of my own thoughts. So my mind, the human being thinks about 60,000 thoughts per day on average. I'm clocking about 95, right? 95,000, give or take, right? So it's just that. But also, the more I use the whiteboard, the more I impress on you. So the one thing you're going to learn about me is I am a mind person. I believe in psycho-cybernetics. I think the biggest asset to a trader is the trader's mind. So as much as we'll spend a lot of time with me drilling and teaching you market structure, how to read the charts correctly, institutional trading, a lot of that time will always be connected to how your mind is digesting that information. Right, I can tell you right now, without a shadow of a doubt, institutional trading is one of the far more superior ways in the markets. Now, I have a library behind me. I have books and books around trading strategies. I have books on the top 137 techniques. My second master's degree was with the International Federation of Technical Analysis. They do teach me everything. And people with that qualification, people get attached to brokers. Broker is a place where you're going to hold your account. And to become a broker, you have to be regulated, right? And you have to, teach your clients a little bit about the markets because it comes with risks, okay? And these guys generally just throw everything at you: Dow theory, Elliott wave analysis, support and resistance, and the list goes on and on and on. And I'm telling you, as someone who sat through this stuff, that institutional trading cuts out a lot of the junk. In fact, everything that you're going to find on YouTube as baby pips is a popular, and I'm not saying those are bad resources. I'm simply saying there's always going to be a very big difference between what we call retail trading strategies, which is everything that you know. Now, some people who come to us for the first time have never traded before. That's fine. But a lot of people generally come to us after they've tried a lot of things and those things haven't actually worked out. And those things are actually in the ballpark of retail trading strategies. Me and you are retailers in the markets. It doesn't matter how big your account is. You could have 10,000 US dollars, 100,000 US dollars as your capital. You will always be a retail trader, because the other side of the market is big institutions. And institutions do not operate around retail trading strategies. Institutions understand retail trading strategies, and they actually use those retail trading strategies to sometimes give you the shorter end of the stick. So you get things like stop loss hunts, where they know that the majority of the market retailers are waiting at this particular level to buy or sell, and they'll spike it. Our course deals with all of that. I'll teach you how to read that. I'll teach you fundamentally, by the time you get to module 2, the only question I'll always ask you is, who is on the other side of your trade? On the other side of your trade. And that's important. You have to get to a point by the end of this course where you can identify that on the other side of my trade is another retail trader. Now, if the banks and smart money, big institutions are called smart money, then us retail traders, the correct term for us is called dumb money. We make money in the markets purely because we can identify correct quality areas of value, and we can also identify places on the charts where dumb money, retail traders, retail trading strategies will be waiting to buy and sell. And it's quite simple. All we have to do is to take the opposite side of that trade, because markets are governed by specific rules and laws. And the first one that I'll be walking you through from tomorrow, lecture 2, is this idea of order blocks. Right? Order blocks and order flows. This is the first thing that we're going to spend the first 3 weeks dealing with. And when I say 3 weeks, I literally mean it. And here we're going to be discussing the 5 types of supply and demand. And before I end tonight's lecture, I will touch on that and start to unpack these concepts, right? So far, so good. I'm hoping, I did notice that the Facebook live stream did pop up. Remember, if you're in the Zoom chat, feel free to ask me any questions via the chat box there, and I'll attend to you. If you're on Facebook, I will do my best to remember to check the comment section and answer any questions that exist. Right, so we're going to spend the first 3 good weeks looking at this concept of supply and demand and the 5 types. Just to give you a basic take on all of this stuff, especially if you've never traded before, my job as a trader in the markets on a daily basis is to understand what's going on. Now, I can understand what's going on in 2 particular ways. The first way is obviously to go back to the actual industry, get attached to a flow trade, and then really see. So I can see the order flows. There's an order book. If you're attached to a broker, they've got order books. You can actually see how many people are buying something at a specific place. You can't lose, right? Because you simply attach your little money to where the big money is. The problem is most retail traders don't have access to that information. Most retail traders only have their trading platforms and their broker platform. So how then do we get to a place where we can actually adjust or see clearly what's going on in the markets? And that's where order blocks and order flows come from. Order flows is a general quantity figure. It's basically money, right? How much money was put in a particular area of value on a chart? Depending on how much money was put in, number one, right? So I'm just going to do this there. So number one, first, there is a specific amount of money put in a specific area of value. Number two, when price leaves that area of value, so let's make this a demand. Demand means buy, by the way. Whenever I'm talking about demand, I want to see price going up. There's a demand for something, price will go up, all right? If there's a demand for something, price will go up. But if there's a demand and we are tracking the order flow and money has leave in an area of value because they've put money, the first thing I will teach you how to track is how much of that money was spent, right, in leaving that area of value, because 9 out of 10 times, not all that money will be spent on the first impulse. All right, so we allow smart money to lead the way. Now, when smart money leads the way, and I'll give you the rules, we have to quantify if it's actually a valid demand. After we quantify that it's a valid demand, there will be rules about the area of value. After we get the rules about the area of value, there will be rules about the volume traded in that area of value. When we secure the volume traded in that area of value, we can then make a decision to say, you know what? This is not retail trader power that's moving the markets. It's smart money. Because of that, I know they're going to come back for the rest, right? So let's say here, maybe just to make this much more realistic, and I do this with crypto, stocks, Forex, options trading, just a little bit different, but the same. Indice trading, NASDAQ, Dow Jones, DAX, whatever you name it, it's the same thing. At the end of the day, markets are human beings. All right. Most of my books that I refer to are all about trading psychology, because understanding the human mind behind the order flow, the reason why a group of institutions, the Bank of England, for example, wants the euro to be strong for a short time period. Understanding that logic means no matter what chart I put in front of you, you can decipher where the money is. So now let's say there's $1 billion here, and this is not a made up amount. It's made up in this example, but it's a real transactional amount. The Forex market alone is the biggest market in the world, right? Bigger than crypto, bigger than stocks, right, for now. And the Forex market transacts about $5 trillion a day. So one bank, one hedge fund committing over $1 billion in a specific area of value is not something amazing, right? We expect that to happen. The difference is, let's say in our example, USD ZAR, right? Let's try and keep it African and local. So let's say there's a buy interest in USD ZAR. Now, if you noted, and if you've been in our war rooms for a while, our USD ZAR signal was triggered a couple of days ago. And as long as that DXY signal, the dollar strength, is still going good, then we're going to be in profits on USD ZAR, right? So I want you, those of you listening who know what I'm talking about, just manage those positions wisely. We don't know how, I don't think dollar strength will last for long, right? So lock profits, get in, get out, just get money and get out, right? So let's say institutions want to buy USD ZAR. Now, here's the logic. The logic is, number one, ZAR standing for South Africa. For those of you who are not from South Africa, I know there are people from Botswana, Kenya, etc., etc. Right, so USD ZAR. The logic here is, number one, the dollar is going to gain some strength, just a little bit of strength for whatever reason, right? So that's the main thing. The dollar is actually going strong. It doesn't necessarily mean the rand is going to be weak, right? I think that's a misconception. Sometimes it will have to become weak. Other times, the rand just stagnates while the dollar is strong or weak. So in this example, the dollar is just going to gain strength against the rand. That's all. So they're going to show that strength by pumping money into the dollar. The dollar is going to be strong. But let's say they commit $1 billion. So the Fed, right? So my favorite people to study, to track, are called governors, reserve bank governors. And we'll talk a lot about this throughout the course, because these guys have a mandate for their country. Reserve bank governor, guys, controls two things. Number one, fiscal policy, how the government spends their money. Fiscal also means wallet or pocket, right? So the government spending the expenditure. But the other important thing that traders generally get lost in and don't know how to track correctly is something called monetary policy. Inflation rates, interest rates, those kind of things. That's where we really want to dance and understand it and kind of figure it out. So let's say the Reserve Bank governor, which is called the Fed in America, needs the dollar to be strong. Could be for 2 weeks, could be for 3 weeks, could be for a month. It really doesn't matter. Needs the dollar to be strong. There will be an identifiable area of value that is predetermined. What that means is that area of value was set maybe last week, maybe 2 years ago. It's right there on the charts. You just need to learn how to read it. But I can tell you where price is going to turn in the next 6 months with that type of accuracy. And I think I've been doing it for a very long time on our public pages just for that social proof. It is not difficult to predict because of this particular example. These guys, when they find an area of value, they leave a lot of money at it. Now, they can't pump $1 billion all off on one trade. to be too easy, number one. Number two, if it was a sell trade, if they should just do 1 billion selling at once, it would create a flash crash. If it's a buy trade, it would create a massive micro parabolic imbalance. Price would have to come back down and cool off. So what these guys do is this. So they say, look, Leroy, I'm working on the floor here. They give you a call, they give the broker a call, they give the money makers a call. We've got $1 billion and we want the dollar to be strong. Buy dollar at 1,256, right? Whatever. Okay, it's actually USD ZAR. So let's make it more realistic, right? So to be something like that. We want the dollar to be strong, but we want it to start being strong against the ZAR at 14.52. All right, I'm just making up that number. My job as a floor trader, which gets interesting. So now we're talking about New York Stock Exchange, Joburg Stock Exchange, London Stock Exchange, you know, and then private institutions. So I was attached to Alan Gray once upon a time, right? Private firms, insurance companies of floor traders. I know for a fact because we work a lot with the Sasol guys. Places like Old Mutual, Salem, all have floor traders, right? Oil companies have floor traders. Big firms that know that they can use the markets as a place to generate more money have floor traders. Your bank right now, everyone on Zoom, on Facebook, all of you guys have a bank account. Your banks do this on a day-to-day basis. I will try before I end tonight's class to touch on this issue around people thinking Forex is a scam. I know that this is a common thing, you know, that comes up a lot. But if Forex is a scam, then your banks are scams because the Forex industry is primarily driven by the banks, right? Where do you think your house bonds, your home loans, your interest rates, all those things go to? They have a team of floor traders who take that capital and make more money out of it, right? And it's all legal, but we'll talk around that later on. Now, as a floor trader, I get this instruction, there's $1 billion, buy USD ZAR. As a floor trader, my job is to start to create the order flows. So I'm going to teach you how to read them on the charts because you're not a floor trader. Now, the order flows are simple. I can't, as a floor trader, pump $1 billion without causing some type of market crisis, without causing a massive economic disequilibrium, all right? What I do, though, is I simply pump 100 million. First, put in 100 million, and that's, you'll see on your charts a massive, beautiful, nice green candlestick. And that 100 million will be followed by maybe 200 million. I've got $1 billion after all to spend, right? So I'm pumping price up. There's that second green candle. By the third green candle, I'll start to slow down. I'll put 50 million only. Why? I'll tell you right now, because every single retail trader in the markets with a trading account has been taught one of two things. Number one, when trading, and I'm no longer talking about institutional trading, I am talking about the people who we should always remember are on the other side of our trade. When trading, retail traders have been taught a couple of things. Number one, they must wait for confirmation. Wait for confirmation. If you've ever traded before, I don't think this will be something that's new to you. Waiting for confirmation means a lot of things to different people. Some people are naked chart traders, so they'll look for a specific pattern, they'll look for a morning star, they'll look for a rising hammer, whatever it is that they've been taught to trade, they'll wait for that confirmation. Some people use indicators, so they'll be told that this thing is now oversold. That's an RSI indicator. They'll look at their MACDs, whatever. There'll be some type of confirmation that tells the average retail trader to buy. By the time the average retail trader buys, they start to buy here. This is where the floor traders cool off. Why spend my client's money as a trader? I know I've got $1 billion to pump, but why spend all of it when I can attract traders who don't know better into the markets? 9 out of 10 times, you'll see something like this. There'll be a fluctuation all of a sudden in the markets. Every Jack and Jill is being taught the same thing. Remember, retail traders have been taught one thing or the other. Principle number one, most common thing you'll find in every trading textbook is the trend is your friend. And this is so true, but badly used, all right? Very true, but badly used. Why? Because if the trend is your friend, then you need the trend to first happen. Essentially, this means don't trade against the trend. If it's green, 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 buy, 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 don't sell. You also buy a lot. The problem with the trend is your friend theory is that most retail traders, because they have to wait for competition, enter here. Now let's do the maths. Our institutional flow trader has spent 100 plus 200 plus 250, 250 million to create a trend. His or her profits are going to come from the runners. Who are the runners? Retail traders who are going to push price up with their own money. Now, I am going to strongly advise against that. In fact, for the next 7 weeks, when we start the course from tomorrow, lecture 2, until you finish it, we don't do this at 365 Trading Academy. Our ability to understand where money is going to go and when it's going to go is our primary trading strategy. We'll talk about our trading edge later. And that is because I want you to be competent enough to understand the creation of a trend, right? And there's a big difference, because if you understand the creation of a trend, it means when order flow trader is starting to pump the market with 100 million US dollars, 200 million, 50 million US dollars, you put your 100 US dollar trade there, whatever your account is. So we trade where the banks are going to trade. Why? Because 9 out of 10 times, and for those of you who've traded before, I can tell you why your account got blown. Even though you were so sure price was going your way, even though market was trending up, 9 out of 10 times, as soon as you start to enter a buy trade, as soon as your screen is blue in profits, almost like the broker was waiting for you, which he wasn't, right? Most brokers don't sit around trying to spy on you, trying to kick you out. All of a sudden, red candles take over. And that's because the smart money understands the logic, right? 9 out of 10 times, when retail traders wait for confirmation, it's too late. Now, you will see this, you'll have entered here, buy. You'll have got into your trading platform, buy 1, 0.01. I'm pretending as if the people watching this video are very good risk management experts and they're not going to do a standard lot size on a 100 US dollar account, right? So let's just pretend that's the case, right? So you enter a buy, you're in profits for about 2 hours, and before you know it, markets have turned against you and you don't understand why. All of a sudden, by hour 3, 4, you are in a negative. By the time, I don't know where you put your stop loss, probably somewhere here, your stop loss gets hit and you lose some money out of your trading account. And the reason for that is, number one, you really have no idea about how market structure actually works beyond what you've been taught. And that's what the course is going to fix, right? So if you're a new trader, you don't have bad habits. And thank God for that, because it takes time for a trader to go through a process where they have to first unlearn those bad habits. For an old trader, you know, someone who's been trading for a while, different strategies, you've seen the highs and lows. If I ask for your performance chart, right, which you can generate from my FX account or my FX book, something like that, you just link your live account with your broker statement with, and it will give you a graph of what your trading journey looks like. A lot of your trading graphs look something like this. A lot of highs, but more lows than highs, and then ends up being one blown account after a blown account. And the reason for that is what I'm simply saying. The way you perceive the market is still through a retail trader's lens. Most 365 students, and I say most because some recently just joined us and they're still learning the ropes, but after you complete my traders process, you would know that the order flow trader and the smart money trader still has about 800 million US dollars left in here of that 1 billion US dollar trade. And he won't leave that money there, because how else can the bank make money? How else can the private institution make money? How else can the hedge fund company make money? They only make money at the rate in which he trades their capital. So a 365 trader will be able to read these levels and come wait here. We call this an order block. There will be an order block here where all the money is stacked. And every now and again, price will come back to the order block to drain the order block a little bit more. The first push was 200 million. This is what we call a fresh touch. The next push might be, in this example, something like 400 million. It'll go a little bit higher, right? Higher than where it stopped. And then later on, it'll come back down again for what we call a retest. The third time, which is the retest, will be the final time a 365 trader trades, because we know that these areas of value can't be held for a long time. The problem with what I've just said is most retail traders have been taught the opposite. Retail traders have been taught around the ideas of support and resistance. And support and resistance, guys, is a fundamental mechanism of how markets work, but unfortunately offers anywhere between a 30 to 40% win rate. And I'm happy for anyone in the world to prove me wrong. Right, I'm really, because I'm just data driven. I would not be trading institutional trading strategy if it did not offer me the highest gains. I would be a support and resistance trader if the data led me to it. Right, I must just remind you guys, I still haven't introduced myself, but my primary background is in research. I just chose to channel my research capabilities and techniques into financial markets. So I study data more than anything else. I want to understand from a financial perspective, from the chart perspective, what human beings with big money are doing and what human beings with little money are doing. And if support and resistance was the holy grail of trading, I would be a support and resistance trader, right? But it doesn't work, and it doesn't work for this particular reason. Sorry, some feedback there from the live. Right, there we go. It does not work for this specific reason. Support and resistance, for those of you who are new to the markets, works something like this. I'm just going to give you guys a very quick introductory to the support and resistance stuff. Well, there's something called a support and a resistance, and really what either or doesn't matter, because at any point in time, a support can become a resistance and a resistance can become a support. But these are psychological levels on the charts. For who? Psychological levels for who? For retail traders. These are retail trader psychological levels, because every single retail trader was taught this stuff, either for free, either by some Forex ninja guru claiming to be a multi-billionaire driving a Bentley somewhere on YouTube. It doesn't really matter where you got the information from. It is the standard retail trader entry education. Support and resistance is equal to this in mathematics. In maths, in grade 1 and grade 2, they'll tell you 1 + 1 = 2, and you will understand it, and it is absolutely true. But also, when you get to grade 1, grade 2, they will tell you that 1 - 2 cannot. That is the answer. It cannot. It is completely are not allowed in mathematics. It's only in grade 5, grade 6, grade 7, where you start to do algebra, where you learn that actually 1 - 2 is a -1. And I hope I got that math correct, right? That there are other negative numbers, and support and resistance does not take traders to that next level. It keeps them at 1 + 1 = 2. It keeps them at a generic understanding of the market. So you can make money through S&R. It's just that with support and resistance, offering you a 30 to 40%, you must be an extremely disciplined trader. Number one. Number two, you must have something called a very high risk to reward ratio. And when I say high, I mean every time you get a reward, every time you get a positive trade in the market, the amounts you make must be so big to cover the 60% drawdown, the losses you're going to make. For me, it is so painful to trade like that in the markets, because market structure differs on a day-to-day basis. For me, there are some days that are just not trading days. I don't trade every day. I'm a swing trader. So I look for primary high probability trades that I can hold for a long time, compound, and I just let the market grow my finances, right? There's a big difference between that approach and just banging the markets every day for $1. Now, support and resistance, just to wrap it up, is this. And let me just draw this line a little bit lower, because I'm going to need you to see what's about to happen here. Right. So a trader who's a retail trader, and dare I say a trader who is not in the academy, is looking at markets like this. There's a support here. There's a resistance there. There's a support down there. There's a resistance. I'm so sorry, guys. Just so you know, the introductory lectures are geared at this level. They have to be slow paced. We're just introducing the course. We will get deeper. You've got 7 weeks with me, and I promise you, you are going to get tired of hearing my voice. Right. So what do you do at a support? You buy. Every time price comes to a support, you buy. Every time price gets to resistance, you sell. This is the idea of support and resistance. Buy, sell, buy, sell. Now, it comes with a couple of things. You will hear someone tell you with confidence, number one, no one can be right all the time in the markets, right? And I agree, that's true. But it doesn't mean you have to be wrong most of the time. There is a way to be right a lot of the time in the markets. In 2020, last year during COVID, and a lot of market, scrupulous behavior, Corona introduced a new element in the markets that I can't find on the charts. And when I study the markets, I go as far as 1935 during the Great Depression, because I'm trying to understand how Goldman Sachs for the last 70 years has remained the top institutional traders in the world. And it's because their trading strategy does the best during crisis. If you study Goldman Sachs, JP Morgan, you will understand why I fell in love with institutional trading. You'll understand why I spent $21,000 on my own education after I realized the truth, right? Not in one place, in 3 big institutions that teach what I'm about to teach you at a disgusting tiny fraction of the price. This idea that no one can be right all the time is true, but you can definitely be right a lot of the time. In 2020, my win rate was 94%. I don't trade all the time. That's the big difference. So I took primary high probability trades that were a banger. For my stock notes and the stock results video for those interested drops tomorrow. Tomorrow I'll be talking about the stocks I recommended in June. Xcon Mobile, AT&T, People United Finance, Franklin Resources, Legit, Armco, Federal Realty. This is in the middle of Corona. These are global stocks. In the middle of Corona, when companies are in lockdown, America is in lockdown. In June last year, Trump was still in power, telling people to drink chloride. I found 10 good stocks that have given us 300% gains if you're part of my stock notes last year, right? And it's all recorded. So it's not like I can claim it now. The stock notes were sent to clients. I'm going to pull them up. You'll see the video tomorrow. It's that type of accuracy that I'm talking to you about. So that's number one. Retail's narrative is no one can be right. Narrative number two is the fact that, well, not only can no one be right, but there's this crazy idea that markets are random. So you can't be right all the time. After all, markets are random. This is a lie. Markets cannot be random traders. Markets are not designed for us. Markets are geopolitical, economical instruments that regulate trade between countries, import and export. If I want to buy as a country, what does South Africa do a lot? South Africa likes to import German cars. So VW, for example, right? There's a VW plant here, BMWs and VWs, a lot of them, I think our BMWs are made in South Africa and exported out to the world. But they are VWs that are made outside and imported into South Africa. I want to buy 1,000 cars from Germany, but I have South African rands. And Germans use whatever they use, whatever currency they use. I need an exchange rate. I need to know how many rands will equal the German currency, okay? And so that it is fair and I can still trade that. My banking system in my country, Reserve Bank governor, regulates that on my behalf and regulates that as the governor of German on the Germans' behalf. That is what the markets predominantly are for. They are tracking PMI data, CPI data, but it's not for the benefit of traders. We were only introduced to the markets in the late 1980s, 1990s in Africa, where retail traders like us could actually trade in the markets. For the most part, this was done bank to bank. An ordinary person couldn't. That's when the third party came into being, which is the broker. to allow retail traders in. So markets cannot be random. In fact, I'll go on to say, despite Milton Friedman's book, which I've read, which talks about the rise of capitalism and free market systems, markets are planned. He didn't like that about markets. He claimed markets should not be planned. They should be free. If markets are free through supply and demand, they'll regulate themselves. Supply and demand will control the price of bread. If the price of bread is now $20 or 20 rands and it's too expensive for the ordinary person, you will see demand shrink, right? And that will communicate to the store owner, your pricing is too high, drop the price. And then you drop the price to 15 rands, and then the demand will come back up. His idea was let the markets control everything. But it's just obvious in capitalism, markets are planned. Not only that, the markets that you're going to be trading in, Forex, stocks, even crypto, right? All of them are heavily manipulated. The retail trader has access to markets Monday to Friday outside of cryptocurrencies. Banks have access to market 24/7. If something happens over the weekend, you'll see for yourself, markets always gap and something always happens over the weekend, which means the banking sector had a 2-day head start to put enough money to move markets in a particular direction, which the retail trader doesn't have. The manipulation just doesn't end there, right? Because they understand that retail traders think through price in these lenses, support and resistance, etc., etc. They also know where to wait for retail traders. For example, if you're going to sell at a resistance, most retail traders will put a stop loss somewhere over here. What's a stop loss? A stop loss is an order, an instruction to your broker that, look, man, I only have $100 in my account. Now, if I say sell and price keeps going up, please close the trade. I only want to lose $10 of my $100. To make money in the markets, you gotta risk money. So that's called a stop loss. Now, let's say you put your stop loss here, right? Like that, just above there. And let's say historically, because as support and resistance traders like saying historically, markets keep coming in this area of value. Markets keep bouncing here, bouncing there, and you realize, oh, this is a beautiful place to sell. 9 out of 10 times, the moment you want to start selling, your stop loss will get hit. Price might go back up or fluctuate up there. When your stop loss gets hit, you take a loss. Banks know exactly where these places are, even for buying. The bigger part about why markets being random is a lie, as I conclude this particular part of the topic, is because markets have a start and destination. You know, the president of the United States has a 4-year term, and I'm hoping Biden only has the 4 years because he's quite old anyways, right? But you can get 8 years as a president. In Africa, it's kind of like the same, except maybe for a weird place like Zimbabwe, where the president just doesn't know when to stop, right? But for most times, and I'm just quickly Googling it here on the side, federal government USA term, right? But for most times, it is determined that a president will only be in for 4 years or at the most 8 years. Barack Obama was in for 8 years. That was how long he could constitutionally stay in place. The federal chair in the United States, right, which currently right now is Powell, his sit is about 16 years, 18 years, or 8 years. It's longer than the president. That's all I know. And there's a point to that. Powell's term. Let me just quickly find it. Sorry, guys. Powell, Fed Powell. I just want to give you guys facts so that I'm not told I'm lying to you. Right. There we go. Fantastic. So I'm going to stop my screen and I'm going to share it because it's important. Because if I'm going to teach you guys how to trade like the banks, you kind of have to know what's being featured in here. So in front of you should be a Google tab. In front of you, I'm not chatting on Facebook, just so you know, this is the live stream. I'm not like, ooh, he's on Facebook all teaching us. No. It's just the live stream, so I have to keep focusing on that. Right, so Powell started in 2014, and he was nominated for another term in June. He was then confirmed by the Senate, blah, 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 for a 14th term, ending in 2028. Which means, if you really think about it, The current Fed, Jerome Powell, was around when Barack Obama was president. He was also the Federal Reserve Bank governor when Donald Trump was president. He is now currently the Federal Reserve Bank governor when Biden is president. And he's most likely going to be around when Biden gets out and he's going to see 4 presidential terms. What does this mean to the thinking mind? Number one, presidents can't come up with their own random economic policy. The Fed will shape it in line with his 14-year tenure. Why are the Federal Reserve Bank's governor terms longer? Because they are literally looking over economic stability. China, when we talk China, China is something called the 100-year plan. That means it doesn't matter who's president in China today. These guys' plan was to go to Africa to buy land 50-something years ago, and every single president who comes into power in that communist country is going to follow the plan. Markets are planned that way. They have a start and determination. The first thing you're going to learn from tomorrow, number one, is order block. Number one is called major turning points, where we actually locate in every single chart the starting point. Where was the starting point? But not only the starting point, we also locate, and by the way, I'm on the whiteboard. So if you can't see the whiteboard, we have a problem. You should be able to see the whiteboard. Let me just reshare that. Right, I'm on the whiteboard. You should be able to see the whiteboard. If you can't see the whiteboard, let me know. Right, but anyways, like I was saying, there's a starting point. Markets all have a starting point. They either start at a demand or start at a supply. One of the two, right? There's just no in between. One of the two. If they have a starting point, markets have a destination somewhere on end where price or an order destination. And it will depend on the time frame. We'll talk about that later. Right? I've got too much blue now on the chart. But which means while every single retail trader is trading support and resistance, markets might very well start below or at a support and maybe respect 1 or 2 resistance along the way, right? Like that. But I can guarantee you, without wasting too much time, markets will then move to start to unravel this little thing. Then all of a sudden, you've lost money there. If you try to sell that at resistance, you have lost money. And the reason for that is market logic. Markets move in zigzag. In a process of long-term retracements, expansion and retracement, but it is not in a random feature. Price, I'm going to remove this out of the way because it's not in my way, is literally simply looking for what it calls its destination. Whoops, wrong tool. Right, I'm too lazy to draw the zigzags. Price is looking for its destination. And along the way, it will create these fake harbors of support and resistance where retail traders trade. And this is where that confirmation nonsense comes from. If the retail trader sees that this is actually an uptrend, price is going up. And after confirmation, they enter somewhere here and price draws back down and starts to sink down. And the retail trader now thinks, oh, okay, I was wrong. It's a sell trade. And they start to try and sell here because price has gone below a support and done a fake out retest. They lose money again there because smart money is constantly going somewhere, either from a starting point to a destination where a destination becomes a start and markets come all the way back down. And this stuff is bounced across order blocks. It can be the stock market. I know a lot of stock gurus will come to me and say, Leroy, we like fundamental analysis when we're looking at stocks. Fundamental. For those of you who don't know what fundamental analysis is, it's basically looking at the intrinsic value of an asset. So what's the company like? Who's the CEO? Does the company have liabilities more than assets? Is the company in debt? What's the cash flow? If something was to go wrong in the company, does it have 3 months worth of enough savings to pay staff, to do blah, 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 fundamental stuff. A lot of traders believe that this shows you the intrinsic value of an asset. I'll tell you right now, as we speak, I'm using Zoom. This is Zoom, the application I'm talking you through. The fundamentals of Zoom as a company are crap. Absolute junk. Zoom predominantly uses people like me, small-term clients. right? Okay, so I run an academy, so maybe I'll need Zoom forever, right? But Zoom became very big because of the pandemic, right? Its infrastructure is continuously developing to meet the global need, right? Zoom just replaced Skype just like that. And there really wasn't much of an alternative competitor. But Zoom failed to produce positive earnings reports last year. Zoom failed to produce good earnings reports in Q1 this year. We just know that Zoom as a company is in profit. But that doesn't stop Zoom from being a profitable company. That's what I'm trying to get to here. The fundamentals sometimes just show us a one-sided buyer story. I can't tell you guys how ready I am to sell Zoom as a trade. So I've got Zoom stocks where I'm buying and buying the dips. But as an actual trade, I kept telling you guys for a very long time that Zoom is going to tank. So I can show you right now. As we speak right now, Corona hasn't come to an end. Some countries, especially in the first world, are actually doing very, very, very bad with COVID. South Africa just announced, third wave, but everyone has started to get used to this idea from working home. And yet, if you look at the Zoom chart, as we speak right now, price is falling. Which chart is in front of you? Screen 2, you should see screen 2. I'm hoping you guys so this is where we bought stocks a long time ago around Zoom, and look at this price got to a place where it just felt a little bit too high for Zoom to justify the pricing sector from its earnings. So about $600 per share roughly, and now prices dropped all the way down to $300. And I like this to happen. I want this to continue to happen because Zoom is a powerful company with poor intrinsic fundamentals, but has a use value. Because of its use value, let me just delete my notes. I know where I bought, so I don't need that anymore. Because of its use value, all I'm going to teach you as an institutional trader is to look at market structure like this and to understand where the next demand is. Where is the next money in this chart right now? Where will price explode from right there, right? And if you're interested and you're never going to join the academy, blah, 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 and I won't see you again, try to catch Zoom when it gets to about $183 per share. All right, 183, you see that it's written minutes to just focus on the amount. At $183 per share, Zoom will explode. In fact, right now, we're experiencing a global meltdown of stocks, right, for many reasons onto this class. I'll pull up another chart. I'm hoping you guys can see all these charts. USD is up, right, falling, melting because of the dollar. See, there's our buy there. I say buy here, and our buy was just above range. I'm very worried. Yes. Okay. Yes. We got a yes. You guys can see the chat. Thank you so much, Connie. You're going to make a great student because I need feedback when I teach. So I appreciate you letting me know if you guys can see the chat. Right. You see, sorry. Was that for me? Someone got on the mic there. All right. I'm going to move on. Right, so when I told you guys to buy USD ZAR, those of you who attend my war rooms, price was here. I just want you to see this. When I say buy USD ZAR, all we had on the charts was something like this. Right, and my instructions, and guys, remember, please, I don't have time to lie to you or to dramatize things. Everything of mine is always recorded. All my war rooms are on the wall. I don't sell these videos. They're there for free. You can review the tapes to try and catch me out on a lie. I say do nothing up here, or I was going to do nothing because it didn't meet my rules. But I knew price had to come down all the way to buy there. We are talking about price in March, only buying now in April, because of this thing, this idea that you can actually predict where price is going to go almost to a perfect T, all right? Almost to an inhabitable perfect T. And the reason for that is all I am teaching you how to do is to track smart money. So I looked at the dollar index. This is actually part of my recent trading plan where I say buy trade. So if you've got my trading notes here, we are in massive profits on the dollar index. So the dollar is going to keep pushing upward for a while. I already know where the dollar is going to get weak. I already have a sell position in place somewhere up here. because I understand market structure, right? And that's what I want you to understand. If you're taking this course with me, it's 7 weeks of market structure. Every single day we're on the charts. Why? Because if someone is going to teach you how to trade, your first thing you want to get from this person is their ability to backtest their strategy. You want to tell yourself, look, man, how often do these areas of value work? How many times does price come back to these things that you're talking about? Because if it's 30 times to 40 times, then you're better off not paying to join the academy and just trading support and resistance. I'll tell you right now, price returns to complete areas of value that are correct supplies and correct demands. And I use the term correct because I've seen in the last 2 years, people talking about supply and demand, but not talking about it properly. So when you quantify your areas of value, you are looking at a 90% rate of return where price will come back to that predictable area. So I always tell people, if you join 365, you are guaranteed an 80% win rate. If you just simply follow my rules. I know it's in the high 90s, but the trader is always the variable. You are the variable, right? The first month after you do my course, you might want to experiment. You'll follow some rules and you won't follow other rules. You'll make some money, you'll lose some money. It's going to be up to you. I can't change that about you as a person. What I can tell you is every single class will be based on rules. I have rules for everything. I don't have a rule just when to buy or sell. I have a rule to quantify supply and demand. I have rules to tell you what type of supplies and demands. Then I have a grading system of what a good supply and what a good demand looks like versus a bad supply and a bad demand. And that grading system affects my risk allocation. There are some supply and demands that deserve 3% of my capital, but there are others that deserve 5%. Then I have rules around the actual climate of price. And it's important to understand what the higher timeframes are doing and how money is allocated and how money is going to flow. And the reason predominantly, imagine Joe Powell's position. Imagine that lady, I always forget her name. She's the Reserve Bank governor for the Bank of England. These guys are in office for 14 years. 14 years. Because of that, I can tell you with absolute certainty, right? And that's just how the financial system is designed. Banks think in 3 months, right? And this is why we have things called financial quarters, because banks think in 3 months. A financial quarter is 3 months, January, February, March, quarter one. April, May, June, where we are now, we're in May right now, we're in the second financial quarter of the year. In their thinking of financial quarter, changes are made to make sure that we're still moving in line with the predetermined plan, quarter to quarter. But banks take profits annually. Banks are what we call positional traders. Positional trader. A positional trader is someone who can hold a trade in profits, hopefully, not in loss, right? In profits for a very long time. We're talking months on top of months on top of months. I am a hybrid of a swing trader, sometimes positional trader. Now, I still haven't spoken a lot about myself and already an hour into this thing. 365 Trading Academy was birthed at the toughest time of my life, okay? I'd gone through a lot of financial stuff. I was a university kid. I liked what I did. I came to Rose University to study law. I did it because, you know, it's what I thought I wanted to do with my life. It's what my parents thought I should do with my life. And at the time, I had entered in the process to becoming a lawyer. What happened to me, though, was the university offered a program where you could do 2 degrees in 5 years, right? And you get 2 credits. So I chose social sciences. So I did things like industrial economic sociology and all the stuff that came with it. And I did my law stuff as well. And it was, you know, in the world of social sciences where I fell in love with my actual passion, right, which is markets. But I was introduced to markets via a stream called industrial economic sociology, which is what I'm doing my PhD in at the moment. And in industrial economic sociology, we've got what we call heterodoxical economists. And heterodoxical economists believe that the markets are more than just numbers. They believe that econometrics and equations can't tell us exactly what's going on in our economy. But to understand the economy, you must understand people. That's why the term sociology is in it, right? Society, people, right? And not only that, you cannot separate economy from society. You see it on the news. There's always a constant separation. You see, I'm going to talk about South Africa. The government till today in 2021 cannot be honest with its citizens about the unemployment rate. They'll tell you that unemployment is at 28%. But if you ask any labor sociologist, unemployment is at about 40%. The government does not want to include people who have given up hope, who have given up looking for jobs. When they say 28%, they're simply talking about people actively still trying to apply. People just come out of university. People are trying their luck. People trying to look for domestic labor. But there is a massive sector of our community that is not even trying, right? The working class, like a big part, right? So industrial economic, sociology looks at all these components into economic activity. Long story short, I like the markets, I like that stuff, etc., but I started trading. I started as a binary trader. I lost a lot of money as a binary trader. So that didn't go well. Then I started options trading. I lost a lot of money through options trading, but I just kept learning, right? So I understood I had to lose money, but I was losing money way faster than I was accumulating knowledge and understanding. Right, there were two problems. I had bad information and I was a horrible trader. There was a lot in me that had to change. And I'm specifically talking about my relationship with money, right? So I started to treat the markets as a lotto ticket, trying to do the get rich stuff, over risking, over trading, all sorts of things. And then eventually I came across, institutional trading. This is after about 3 to 4 years of a tried and failed process. Now, institutional trading did a lot for me. First of all, I calmed down, right? I had to first understand what the market structure was doing. And then moving forward, I had to understand my role. How do I actually get money? How do I extract money from this thing? Now, during my learning period, I gave myself 365 days. This is after 3 years of losing, I've been in the markets for a very long time, guys. But after this, finally equipped with the right knowledge, I back tested this thing for 365 days. I did not trade it for 365 days. I simply back tested. I looked at every single prediction. I kept drawing zones, hoping price would come back, to build confidence in my ability to understand market flow. But in the background, I had 3 positional trades. And I'm just letting you know how my academy came about. 3 positional trades in the background that changed my life. Because I finally understood that if a bank can hold price, if a bank can hold markets for a year, remember that's what we're talking about. We're saying banks think in 3 months, but take profit in a year. And when I just as an experiment, I did it. And all of a sudden, those trades that I'd held that followed the trend, from the creation of the trend, from the starting place of the trend up to the destination where I took profit, that changed my life. That's when I realized, oh my God, that's some serious money. I could pay back some debts, sold some cars, lost my motorbike. I lost a lot to the markets, but my life changed from there. And I used that money to empower myself more, spent another 2 years learning, and then got licensed. For those of you who don't know, I've got with the South African Financial Markets Institution. I've already told you about my IFTA program. We run 365 Trading Corporation. I will never, please don't even ask me. We do not trade on behalf of individuals, despite having the license to do so. I feel like individuals need to be in a better place to be empowered, especially in Africa. That's what the Academy is about. I want you to learn to trade for yourself. I want you to learn to raise your own money, right? 365 Trading Corp deals with corporations who need third fund income streams. So our biggest clients are things like NGOs, financial sectors, whether it's trading on the floor or actual corporations with a lump sum of money who want us to duplicate it and increase it for them. Sure, that makes sense from a corporate perspective, but individual traders must undergo some type of process. Why? You can never in your life get scammed, ever, if you control your account. I don't care how genius the scams are out there in the world. You always get scammed if you give someone your password. You always get scammed if you give someone your cash, right? It's highly likely it's going to happen. Maybe the person is trustworthy. And I've seen trustworthy people do this. I've seen people who are not licensed like myself do account management and do it well and give people their money. But I know that those people are rare. I don't even recommend people to the people I know because I don't want to be involved when something goes wrong. If you want to grow your money, you go to a financial advisor who's licensed and registered. Let's use Old Mutual as an example. The problem with these people is you are going to get a penny for your thoughts, right? There's going to be a 17% fee, and then there's going to be a commission fee, and then there's going to be a monthly management fee, right? So if you do things like unity trusts with like Old Mutual or these financial packages where every month you send a debit order and they go invest in the markets for you, they will always make more money and they will give you anywhere between 2 to 5%. This is literally what they sell you, 2 to 5% above inflation. Guys, I want you to understand this. I'm saying they are institutional, and I'm not using the term institution like I've been using it throughout this class. They are institutions, actual big institutions that take people's money and they say, look, invest in this thing, buy this financial package, and then we'll put it in the markets for you, all right? And then you will, after 5 years, it'll be this amount. But every year, they are simply paying you 2 to 5% above inflation. So let's say you give them $100. Let's say in the market, your $100 after a year becomes 1,000. I'm just making up numbers here. Your account will get a 5% bump of the $100 if inflation is about 4 to 5. If inflation is at 7%, your account will then get 8% of the $100. The question is what happened to the other $900? It is taken by the financial company legally. Why? Because you're ignorant, because you don't know how. You don't know how to generate wealth for yourself. And because of that, you do it in the Forex market, in the stock market, with Bitcoin. The money goes to the trader who understands market structure. And that trader gets 100% back of his capital and whatever X based on their leverage. Could be 100x on top, could be 1,000, could be 10,000. I'm not trying to sell you dreams. I'm simply saying you will always get the full value of your money from the markets if you're the one extracting it. For account management for the corporates at 365, I charge all my clients 50% of the profits we make. I'm not charging them because it's a lot of hard work for me. I love what I do, guys. If I'm not in my home office, I'm in my actual office there. We are literally trading every day. It's not difficult what I do anymore. It's a routine, but I'm not charging you 50% of $10,000 because I spent the whole day working hard like a miner and I'm sweating. I'm charging you based on knowledge because I know and you don't know. And because I made your $10,000 $30,000, and no bank in the world could do that for you. No one in the world could give you those rewards. Because of that, it's very much fair for you to give me 50%. It's simple. I believe every single retail trader should be empowered to do that for themselves. All right. And as I come to the conclusion of this introductory course, that's what I'm driving to you guys. So it's going to be 7 weeks. 7 straight weeks where I'll be doing my module 1, module 2 with you, and then you're going to do module 3 via the remote course, and that's how it's going to work. We are going to be in class just like this on Zoom, right? I have not added the new people to our private students group. It's been so hectic, guys. I had a tooth extraction, by the way. I'm feeling much better today on Monday. Last week I was actually completely sick, so I'm a bit behind with a lot of things. But if you've actually registered already, you will be added to the private students group by tomorrow, all right? And in there, I'll send Zoom IDs like this. We will have class every Tuesday, Wednesday, Thursday, without skipping a beat for the next 7 weeks. Please budget the time. How do I work? I teach you for the week, Tuesday, Wednesday, Thursday. On Friday, I will send you a written PDF summarizing what I've taught you on Tuesday, Wednesday, Thursday that week. So you're going to get 7 PDFs by the end of the course. They are very short. They are 10 to 12 pages at most. But what they do for me is they make sure that I know that you know what I was talking about. We all write notes differently. So what the PDFs are is a basic summary, a very good summary of what I think are the key points are. They'll have pictures of the charts that we discussed that week. They'll have pictures of the whiteboard. It's a very interesting to detail thing, but I know that's what you have to look at on the weekends. Outside of that, you also get recordings. So I'll record the Tuesday, Wednesday, Thursday classes, upload them on a Google Drive so you can review them in case Leroy is not there 2 years from now and you want to go back in time to understand a key order block, etc., etc. All right, this is it, guys. This is kind of like how we do things in the academy, especially for our traders course. There is no sunshine. There is no $1 million promise at the end of the road. There will be no overnight miracle. I am very good at what I do. I actually used to lecture, and I still do, I guess, but more on a contract basis. I do lecture at Rhodes University. I understand pedagogy. I understand the delivery of information. I know how to package stuff to make sure that you understand it, right? I'm very patient. I teach in loops. No one will be left behind, but you as the trader, guys, I must tell you, I will expect a couple of things from you. Number one, because it's not a free for all. I'm not your, what's the term? You are not the client, and you're not a customer, right? You're enrolling into a trading academy, and we have a responsibility over your education. We are going to deliver. But in the same way, we expect a couple of things. You need to attend class. Relying on the recordings is a very bad habit, right? So the recordings are good to refresh your memory, to recap over the weekends, but class is compulsory. You have to attend class. You have to watch me go through the stuff with you. You have to ask questions in class so I can deal with those issues right there and there, right? I do temperature checks in between each class to know that we are all on the same page together. This is key. Apart from that, you have to, no matter what, for the rest of your life, up until you get to a place where you can literally come back and say, Leroy, I have found a better way. A better way, guys. This is me. It's not to brag. It's not to impress anyone. It's just data. If this is, we have to be proud of what we've done. I've got 102 six-figure traders right now in the academy. From the academy, part of this 102 six-figure traders, we have 6 trading proprietary firms that they've created. Six trading firms that I'm not in charge of them. I don't run them. I don't invest in them. I don't have shares in them. These are people who just went through this course, went through your process, and they've started their own. Every year, I visit them. We do like a floor trader seminar talk. I check their books. I empower them the best I can, but that's unbelievable. I've got about 36 other traders with high 5 trading accounts, high 5-figure trading accounts, who are going to be moving soon to join the 6-figure accounts. This group, the 102 plus the 36, we call them 365 senior traders. A senior trader in the academy is someone like you who joined, right? Did module 1, did module 2, and then went out to the markets now to go fish, to go test this knowledge. And what we do is, because I'm very methodological, there is no fee to join the senior traders program. You simply need to prove it. You need to prove that you can become a senior trader. How do you prove it? We ask for your broker statement, and then we assess you. I assess that you followed the rules, because the 365-day mentorship program, which is what you'll have paid for anyways, after you do the course, you don't just disappear. You still have to sit through 1 year of mentorship with me. Some of it would involve one-on-ones, group tasks, blah, 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 blah. But the point of that is to make sure that you're following the rules, rule-based trading. This is my biggest expectation out of you if you're going to join us. If I say sell high, buy low, and then I teach you how to quantify the high and how to quantify the low, I then will have that expectation out of you to do it. Now, it doesn't mean you must get it right the first time. We're going to make so many mistakes, right? It's a very patient process. But I'm simply saying, if you want your account to grow, you are going to have to adapt to the rules. Just in the same way as a sober driver, when they see a red robot or a red traffic light, they stop because they're sober, right? And then they see green, they go because they understand what it means. There will be red signs that mean don't trade, don't buy here, don't sell there. And you will be expected not to do that because doing it will result in something drastic, a loss. You will lose. You don't follow the rules, you will lose. It's simple. Markets are moving all the time. There's someone buying right now as we speak while selling. You guys saw that we are in profits for USD ZAR, and you also saw that we're in profits for DXY. And in both those profits, we are buying. Can I tell you right now, at this moment in the world, there is someone trying to sell these assets right now. Even though we are buying, we've actually been buying for a couple of days. I think we've been in profits for about a week. As we start, will you want us to use a specific broker? If yes, which one? All right, cool, Konya. I'll respond to that question right now. Right. So it's very, very important that you understand that all I'm going to do for the next 7 weeks is impact market rules that actually work. Number one, that can be verified. Number two, and tested. Your job is to become a rule-based trader, which is so difficult. Right. Everyone, not everyone, most of you who are part of my mailing list who said they want or were interested in the traders course, I've already sent you your first book. I am a lover of books. I love to read. In fact, I learn better from books. A book, a 200-page book, is someone telling you that they've got 15 years of experience in this particular field and they've put it together in 200 pages. They've given you the best shortcut in life. 200-page book is about 20 chapters. 20 chapters. My rule in the academy is, if possible, and you can't afford not to, read 1 chapter a day. A chapter a day, I know I'm misspelling the word chapter, don't worry about that. A chapter a day is about 45 minutes. That's what I'm asking for. 45 minutes of your time. You want to be a trader, right? You want to make a lot of money. This is the cost. It's a $210 US course, which some of you have already paid for, right? Some of you have already registered. I know that some of you are going to register on Friday or are making these arrangements. That's perfectly fine. But the second cost to becoming a very good, profitable trader is investing in yourself. You got to read the books. Now, I'm not going to send you books on trading strategies. That's my job. I will teach you institutional trading day in, day out for the next 7 weeks. But the books that I'll send to you are around trading psychology. The first book that every single one of you should be reading right now is called Disciplined Trader by Mark Douglas. This is the standard book 1 in the academy. The next book is called Trading in the Zone. I will give it to you in the next month because I think by the end of May, you should be done with Disciplined Trader. If you're not big on reading, then just 1 chapter a day, because he deals with things that we might not have time to deal with in the class. I can go for 2 hours, and some classes I even go up to 2 hours, 30 minutes. If the class allows me, I'll ask guys, can I please go over for, just for another 30 minutes to finish? But some classes end late because there's still so much to talk about. But you leave the entire course very much empowered to navigate the markets. I can guarantee that. But the things that I don't have time to discuss and correct at this stage, you find them in the books. We will fix trading psychology in the 1-year mentorship program, because again, trading is 80% psychological. Right? That's why you've got the 1-year mentorship, but it is nice to talk to someone who already has these concepts grounded because I've read my Mark Douglas book. Right, so guys, I could talk and talk and talk. I think I've done a good job at introducing the course. I don't know what else there is. The main thing, and just to reread Connie's question. Connie, I hope I'm pronouncing your name correctly. I'm very bad at pronunciations. Okay, I see the chat was sent privately. Sorry, that's why. So people probably think I'm talking by myself. Right, so the question was, as we start, you want us to use a specific broker. Right, so we'll talk about, yes, I am, fantastic. We'll talk about brokers much later, Connie. We'll talk about brokers much, much later. In fact, it's just a general rule that I have that everyone right now is at a trading freeze. So if you're new to the course, or if you're an experienced trader and you're doing my course, for the next 7 weeks, I'm going to ask you to just pause. You can trade if you want, but it'll be very much better if you can just wait to finish the course before you go back. What you will need though is access to something to, you froze already, fantastic. You will need access to TradeView. So my next email to you guys, I'll just give you a link to TradeView. TradeView is where we do a lot of our analysis. There is no need for anyone to pay for the Pro TradeView account right now. The free TradeView is good enough, right? I generally tell people only start paying for TradeView when your business is doing well, your trading business is doing well. And then we'll talk about the features in the Pro account, right? So I'll send you a free link to TradeView. If you've never, TradeView is this platform here. I think I'm sharing my screen, and in my screen, you should be able to see charts. This platform here, whenever you see me link to FXCM, it's the live brokers account that I have with TradeView, right? So let's go to a currency, right? So it really doesn't matter. But I do have a specific list of 5 brokers that I normally refer people to, and that's generally based on either our understanding of that broker, right? I like ENC brokers. I like brokers without trading desks, right? And we'll talk about all those things. And maybe to conclude tonight's thing, really to conclude tonight's talk, guys, because I've really gone over time. And I apologize, kinda, not really, because class ends at 8:30 and it's only 8 p.m. But introductory lecture is normally an hour. Just to tell you guys, every single broker in the world, every single broker, cryptocurrency, forex currency, stock broker in the world uses an algorithm. What's going on with my spelling today? Right, an algorithm. Sometimes when I power up my MT4 platform, right, on AvidTrade or IC Markets, there will be a system called is it Guardian Angel? I think it's called Guardian Angel. There's a small gray box that pops up. Anyway, it's called Guardian Angel. It's a tiny gray box, and it says, "Hello, Leroy. Hope you're well." And if you click to the right of that little small gray box, it'll tell you everything. It'll tell you your statistics. It'll tell you that, listen, man, your win rate is 50%. And it'll be better if this week you hold your trades to gain about $200 profit. So start holding, or let's make it a small amount, $20 profit. It'll give you all of this stuff. Now, to you, the trader, it's amazing, right? Because you've got a system that's keeping track of you. And a lot of traders don't even look at that. A lot of traders never review the statistics, which I think is horrible. There's no industry in the world where you don't get to review your stats. If you're a soccer player, they'll tell you how many red cards you got in a season, how many scores you got in a season. If you work, your boss should do an evaluation about your performance. It's only traders who open and close trades, keep refunding accounts, and they don't pause to actually say, who is the problem in the markets? Is it me or the markets? What is the actual problem? The Guardian system is actually an algorithm for your broker. It will tell you stuff that you need to hear, but what it's telling your broker on a day-to-day basis is the following. Number one, and all brokers have this, how many trades a day you make. How do brokers make money? They start to make money the moment you start to trade. It could be swap charges, spread charges, the fact that you're losing money or blowing money. No broker makes money because you just opened an account with them, deposited capital into the account, and then you did nothing with the account. They start to make money the moment you start to make decisions. The moment you start to make decisions, you become a paying client to the broker. Now, brokers are different, and I'll talk. We end module 1 with the broker conversation. But the algorithm is looking how many times a day you trade, when you trade, what you trade a lot, your statistics. So this will be your win to loss rate, your percentage gain, very important to know, your drawback. Right, so this is, I won't list all of them because it need me to think very long and hard, but there's about 20 things that algorithm tracks. Let's say you get a dingy broker, and a dingy broker, guys, are those weird brokers who offer you bonuses or whatever, or brokers rather with a trading desk. And I don't want to spend the whole night on this topic because we can talk about this for a very long time. What is a trading desk? A trading desk is simply a market maker broker. A broker who's classified also as a market maker. And what that means is this broker is legally allowed to take trades. And you're like, Leroy, what's the problem with that? Well, the problem with that is brokers, which is something that most people won't tell you, classify traders into 3 books. And we talk about this in the course. Book number 1, let's call it book A, right? Oops. Okay, that's an A. Book A. Book A is for consistent losers. People just lose all the time in the market. How many losers do you think there are? 90% of retail traders lose 90% of their capital in the first 90 days. It's been like that since the beginning of time. All right. Some brokers like IG Markets will tell you, hey, our thing has gone down to 75% of retail traders losing money. And that's because IG Markets is now very strict on who uses them, right? There's a criteria now to get into IG Markets. Some brokers will tell you it's 80%, but generally speaking, 90, you can even Google it on Google, 90% of retail traders lose 90% of their capital in the first 90 trading days. These guys go into book A. Book B is where you'll find a lot of 365 traders. Right, consistently profitable traders, right? These are the traders who, generally speaking, will make money 9 out of 10 times in the market. They're in a specific book, right? And then group C is a hybrid book. Sometimes you're losing, sometimes you're winning. You're not yet a consistent loser, but you're not a consistent winner, right? You're in a hybrid book. A broker with a trading desk, and it's a very big problem to retail traders because they don't understand, again, markets are not moved by indicators, support or resistance, blah, 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 blah. Markets are moved by money. So let's say you got a $200 US account and you have a dingy broker. And this broker, not only is he dingy, but has a trading desk. And you open Euro USD sell at 0.02. This is a lot size. For those of you who don't know what lot sizes are, 0.02. But you're already in this book, book A, of consistent losing. The algorithm knows that you take 10 trades a day, you open and close, and you normally trade between 7 p.m. and 11 p.m. because you're back from work, and you like to trade euro for whatever reason, even though the London session is closed because you don't even know about that stuff, and your statistics are you will lose 90% of your trades. The broker doesn't have to think too hard about what to do. You only got $200 US at 0.02, which means mathematically speaking, you're risking about $10, $20, somewhere there on the trade. All your broker has to do is to put $1,000 US against your $20 US and buy Euro USD. Who do you think is going to win? Who do you think is going to win? If I have $1,000 US to push price up and you have $20 US to push price down, let's say there's 1 million damn retail traders selling Euro USD at the same place with their $20 US by 1 million. And let's say there's 20 million US now in the markets trying to sell price there. But you're talking about a market maker and they put $1 billion US to buy Euro USD against 20 million. Who's gonna win? You see now, so the dynamics are multi-diverse. You need a good trading strategy. You need to be a good trader. But not only that, you need to have a good business partner. Our brokers are business partners. I will never put money in a broker with a trading desk. And if I do, I need to understand where that broker's loyalties are. Are you a market maker in the exchange or are you a market maker here? If you're in South Africa, if you're not even in South Africa, just for some good night reading, Google JP Markets. So just say on Google South African government, SA government versus JP Markets. JP Markets was, I think, the king of all scandalous brokers in the continent of Africa. JP Markets was not even sending their customers, their clients, the traders, accounts and trades into the exchange. A broker's job is to send you to the exchange. Simple. Go to the exchange. JP Markets was sending their clients in a market climate condition within their servers. So they were not even trading in the real market. And JP Markets was beating and winning against their traders in what we called very, very, very pessimistic, negative market conditions. They're not the real exchange, right? So you'll get these type of brokers who are very dingy. You'll get a medium-sized dingy who are legally allowed to trade against you. So you must know all these things. So we'll talk brokers later on, but the first thing I want everyone to have right now is TradeView. Have a TradeView account. It's for free. I want you to learn how to do market analysis. Every time I teach you, after 1 week, you practice that stuff over the weekend. On Monday, on Tuesday, when we meet up, I'll ask you for questions, and then I'll move on to week 2 stuff. Ladies and gentlemen, I have honestly arrived at the end of my class. I have thoroughly exhausted myself. This is just the introduction. I literally didn't even define supply or demand. I didn't tell you guys the 5 types of supply and demand. There's a lot of stuff that we're going to uncover. Thank you as usual for joining me on Facebook. There's someone there. I see you. I appreciate the comment. Siyabonga. Freezing everything. You've learned a lot. I appreciate that, man. I appreciate all of you in the Zoom room. If there are any questions, I can deal with questions right now before I quickly exit. If there are no questions, I'm happy to call it a night. Just so you know, thank you so much. Uncle EG. Uncle EG, hey, good to see you, man. Blessings. I don't know. You should be teaching. Maybe one day we'll get EG to teach. All right. I appreciate all of you guys.